Hi, everybody. This is Chris with Invest LYH. And today I'm just going to go over an article that I read recently. And I thought it was interesting because it looks at people who have e- equity investments um, over $1 million. And I just thought it was interesting because it kind of shows you the understanding of how people um, who have $1 million over to invest, so millionaires, how they look at investing. And I do have my cat here. So say hi, Ollie. He's just kind of walking around while I do the video. So if you see his tail going, I apologize for that. But what we're going to do is I'm going to go ahead and share my screen here, and we're going to go ahead and look at the video. Sorry, Ollie, get out of the way here. Sorry about that, guys. Let me go ahead and grab my I gotta find the where is it? Huh. Yeah, let me just share the screen itself. You might see like picture of me. Yes. And I'm gonna go ahead and bring up my there we go. All right. So now I'm just gonna scroll up, right? We'll go over a few. I have a few highlighted areas, but I'm just going to go over a couple things just to showcase it. So the name of the article is Millionaires Speak: What Drives Their Personal Investment Decisions. And the idea behind this video is to kind of get into the mindset of what a millionaire does with their money, right? We always think about what like certain gurus say. Ramsey is one of the big ones out there, right? Warren Buffett is one that a lot of people in the investment world look up to. But I wanted to kind of look at it from an academic perspective, taking the theories that are out there and applying it to what the millionaires actually do, right? This is a survey-based data, and what they do is they ask them a series of questions to see where they invested and why they invested that way. So, and you can see right here, right off the top, right, it's over 2,400 individuals with at least 1 million of investable assets, and how they looked at based on leading academic theories. One of the things that they found out was that they concentrated equity holding, and it motivated them because they had higher risk adjusted returns. And that's something that we're going to discuss a little bit later. One other idea here is active equity fund investments were their uh, where they're most likely, that's where they're most likely to put their funds in an active investment, not a passive investment. So right off the bat, this paper is going against what Dave Ramsey teaches of those passive index funds. Millionaires say no. We look at active investments because we see that they're going to get higher average returns. I'm just reading the stats here. So let's scroll down a little bit more. Why did they look at millionaires, right? Because based on a survey that they read by this guy here in 2017, the top 1% of the U.S. households held 53% of stocks, 65% of U.S. financial securities, and the top 10% held 93% of stocks and mutual funds. So they wanted to see what the top end of the earners in the country looked at. This is the most, as far as I know, this is the most up-to-date data on that in an academic sense. Keep in mind, a news story on Fortune or a news story on Forbes does not have to be vetted by professionals, which is why these peer-reviewed journals are so important to the academic institutions, because these ideas need to be vetted in order to look. And I understand that there's been some questions around that, but we got to take it at face value. So, and then it says down here, each of whom had $1 million in investable assets, 18% of whom had at least 5 million, and 4% of whom who had 10 million. So this is, I would say, a good subsegment of millionaires. So what we're going to look at is, I'm going to scroll down a little bit more. Well, I highlighted quite a bit here, right? One of the things, like this one here, right? The average household asset allocation is heavily driven by discomfort in the market, whereas the wealthy allocation decisions are more likely to be aided by the advice from professional financial advisors. And they lean more on their past experiences. This is something that I think is critical to the real estate investment mindset. Experience matters. Other people's experience matters. And when we look at this, right, if you want to be a real estate investor, this green highlighted area here, you need to focus on that. You need to experience stuff, number one. And number two, you need to take the advice from people who have either experienced it, number one, or helped other people who have went through the experience, number two. That is a critical difference between the average investor and the wealthy investor, the millionaire investor. Okay, so just keep that in mind. This is why I wanted to do this. I understand these are based on equities, but these are mindsets that millionaires have that the average person may have, but maybe they don't know that they need to change. So one thing we talked about earlier was about the active versus passive, which goes against Dave Ramsey, and we're going to talk about another one that we saw later in that goes against what Dave Ramsey says as well. So this is just some of the survey data here that I thought was interesting. I know that in my study of the wealthy people, right, we see on Instagram a lot of these wealthy millennials, right, and they're doing all this stuff. Well, the data doesn't point that out. The data doesn't play that out, right? Most people are wealthy later in life. And if you think about it, you accumulate wealth based on working and income. Your income then translates to asset purchases, which then accumulate over time, right? And this is the perfect example of that. One other thing here, if you've read Tom Stanley's book on The Millionaire Next Door, marriage is the way to wealth. Plain and simple. Tom Stanley says it. This academic paper says it. Most things say it. So whenever you can get married, you got to find a partner that understands exactly what you want to do in life, and can you guys accomplish the goals together. So let's continue to scroll down. All right. Another one here that I thought was pretty interesting: real estate investments excluding your own home has percentage of has positive holdings, 34%. So just about over a third has real estate, even though they have at least $1 million to invest in equities. A third of them have real estate that produce something, right? So keep that in mind. I mean, there's a lot of people out there, oh, only equities, only equities. Well, of the assets they include, a third have. The other one that I think is big is this 93% have cash. You got to have cash. Like these people who are telling you that you can buy property without cash, you're wrong. You can buy property with other people's money, but you have to float certain things for the time to go across to when you can pull that money back out. You just have to. It's always nice to have cash. So let's continue. I'm going to scroll down to my next section that I have highlighted, which, come on. Yeah, I know this makes for riveting video, right? Oh yeah, this goes back into the fear versus taking a risk, right? A lot of people are fearful, but generally the wealthy people are less likely to be afraid of taking a risk. So keep that in mind. Here's a perfect one here, right? These are what they used for factors that go into investment decisions. And they have the representative population, so the average person on the left side, and they have the wealthy or the millionaire side on the right side. And I highlighted them based on where they were. So the first one is advice from a pro advisor. The wealthy investor, that is their number one reason why they choose to make an investment. Whereas it's 23rd, or I guess 23rd for the average investor. So if you want to transition your mindset from the average to the millionaire mindset, that is your number one thing that you need to do. Get advice from professional advisors. Now that's in the equities line. In real estate, I would say you need to find investors who have done it before. I'm not talking about a guy who has 100 units. I'm talking about the guy down the road that you know that invests in the house next to him. How did he get there? Then you find a guy who has 4 units. How did he get there? Then you find a guy who has 8 units. How did he get there? And you continue to grow on that. And that is the number one way that you will become a millionaire real estate investor. Now, on the flip side, we're all people, right? So you can see here that number 2 is years until retirement, but that is the number one average way. Well, I got plenty of time to do that, right? That's not how millionaires look. And then the third one, personal experience, which is 26 for the average. You guys got to look and you have to try. You have to try. That's what you have to do in order to become a millionaire. Experience living through stock returns. That I highlighted that one because I couldn't even find that one over here. If I look again, yeah, oh, there it is. Yeah, it's number 21. So again, these top ones here are low. The other one that I saw was religion. I thought that was pretty interesting. You got to you got to have faith, right? And if you don't have a fear mindset, you have to have a faith mindset because you're taking a risk where it might not work out. I've started and sold several businesses in my time, and every time we opened the door, it was terrifying. You got to have faith that something that you're doing is going to serve other people and it's going to work. So let's continue to go down here. Okay, and this is the other point that I wanted to talk about when we talk about the people like Dave Ramsey. Wealthy households are particularly likely to hold large, undiversified equity positions. They do not diversify. And if you think about it logically, now I think 30% of these respondents owned their own company, whereas 60% or 70% did not own their own company. When you own your own company, it's easy to say, oh yeah, we're going to have an undiversified position because we're going to put all of our extra cash back into the business. Well, if you are working for a company and you believe in it, you need to get an equity position in that company and you need to funnel cash into it to purchase more equities. That is how you make that exponential growth, right? And it plays out right here in this data set, right? Wealthy households do not diversify when it comes to investing. They understand their niche, they understand where their comparative advantage is, and they make decisions based on that. I see a lot of people on Twitter. I love them. They talk about, oh, well, I do real estate investing and I have index funds. I diversify. If you're good at finding real estate deals, stop diversifying. Diversifying is for when you retire. It is not for when you're actively working to attain assets. That's what the data shows. I'm sorry. Ramsey talks a lot about getting out of debt. Perfectly fine with that. Then he says you need to save cash. Perfectly fine with that. You can't invest without cash. Then he says you need to invest in index diversified funds. That's not what millionaires do. Millionaires do not save their way to success. They invest in highly likely exponential growth assets. That's what they do. That's what the data is telling to us right here. I'm going to keep scrolling down, but so the two things I wanted to showcase was that you should not diversify. You should absolutely work your comparative advantage if you want to be a millionaire. And you need to have advice from professionals in the area. And in real estate, it's a little weird because professional real estate people are realtors and they're salespeople. I'm not talking about a realtor. I'm talking about an investor who has multiple units. And I'm not talking about 100 units. When you want to talk to a guy who has 100 units, you need to have at least 80, because he is going to be talking about strategies that have to do with creative financing and equity plays, forced equity plays that you are not ready for when you have your single family home and you're about to put a HELOC on it to buy a property down the road. You need to find a real estate meetup group would be an excellent place to find somebody who went from 1 to 2, 1 to 4, 1 to 10. Then when you get up to that level, then you find that person who has 40, 50. When you get to there, it's like a step up, right? You step up, and then as you step up, you find that additional person that is going to be able to help you get to that next level. That is what this article translates to the real estate world. If you want to be a millionaire mindset, you need to be able to find that professional who has done it and be able to identify how you can do that. Well, oftentimes successful people leave clues, and you need to be able to identify those clues. A lot of them will tell you what they are, which is excellent. So the way that they identified how people were not diverse in their equity holdings is they looked at the concentration of their holdings, right? People understand that there is an advantage to knowing a tried and true way of serving customers' wants. A lot of people talk about wants versus needs. As an economist with an econ background, I will tell you one thing. Wants are what we make purchase decisions on, not needs. I owned a cookie shop in a high-end area. Nobody needs a $5 cookie, but they want one, and they bought them to the tune of hundreds of thousands of dollars every year. You supply people for their wants, not for their needs. That somewhere along the line, people said, oh, we got to supply people's needs. Not true. Now, in a business sense, it's a little different, right? You need to you have a project within your group that you need for expanded operations in California, for example. Well, you need to have this. You supply the need. When it comes to consumer decisions, we purchase based off of wants. And we are in a 70% or even more of a consumer-driven economy. So that is where you need to make the play. Conclusions of this article. I know this video is long. I hope you guys stayed through it. If you did, give me a thumbs up. It shows here that they look at professional advice, time until retirement, all those things that I listed earlier, right? Where it had the religion, it was number 9, and then down on the bottom. The top factors were right here of why they determine their equity share in their portfolios. Right here, our respondents often exhibited confidence in their ability to identify superior opportunities. Rich investors collectively believe in high profitability over highly risk-adjusted stocks. If you're based on fear, you're not going to become a millionaire, is what they're basically saying here. Conversely, they do not believe in high momentum. I think there's some more down here, right? Nearly half our respondents have invested in active invested strategies. You have to be active. You cannot be passive. I'm sorry, Ramsey, you can't be, right? How do you identify? And remember, I was talking to you, okay, well, how did the guy get from 1 to 4? Right here, past fund manager performance is seen as strong evidence for stock picking skill. Let's translate that to the real estate world. Past performance of how they got from 1 to 4 units is strong evidence on how they can help others get from 1 to 4. That's why you're watching this channel, right? You want to figure out how to invest. I use cash on cash return because somebody taught me that. And it is the best way for me to take $1,000 here and identify what I'm going to earn on that $1,000. It's similar to a bond holding. That's it. So I'm going to scroll back up just to pull up the name of this paper again. Um, I hope you guys like this. You know, it's a new thing I'm going to try just because it's some deeper content. But you know, we all want to be able to figure out how to earn some money. Millionaires, this is what drives their personal investment decisions. This is vetted information that is from the Journal of Financial Economics. It allows for you to understand how a millionaire thinks when they make investment decisions. Hopefully you like this, and hopefully it'll help you understand what you need to do in your investment strategy. And if you guys have questions, please let me know. I'm going to go ahead and stop sharing. I'm going to look at you guys now instead of looking at my little box over here. There's a little box over there of me. And I look at that, but I appreciate you guys watching this. I know it's a longer video, but keep watching. Let me know what else I can do. I'm going to start doing some of this long form content and just diving into some articles that I find interesting. Some of them are on real estate. The difficulty for me with real estate right now is I'm having a hard time finding up-to-date data. A lot of people are looking at Case-Shiller from 16 back. And I'm like, man, we can't, it's not the same market. So anyway, thanks for watching, guys. You guys have a great day.